And good morning to everybody in the US and to those of you elsewhere, good day. Um, Thank you for joining us. And today we'll do the Future of Everything report for February. Just before we get started here, just a short disclaimer. Here we go. The information in this presentation is not intended to provide tax, legal, insurance, or investment advice, information, or opinions or recommendations are solely for informational purposes, constitutes the author's best judgment, and only valid as the date of this presentation, and are subject to change without notice. Okay, so we had an interesting discussion in the very beginning, just talking about there's something about this time that seems different, right? I mean, we're in interesting times of all sorts. There's a phrase by the popular Bob Dylan that I think is appropriate. The times, they are changing, and indeed they are. They seem to be changing faster than ever. And so we're going to try to capture that imagination a little bit in this presentation as to what that means for us going forward, as this time definitely seems to be a little bit different than maybe what we've previously experienced in the last maybe 40 years. One is that you might be looking at what's happening in both the economy on a local level, your level, what's going on with your job, so forth, lifestyle, purchasing habits. As you know, inflation is a big part of what's going on. And yet the stock market till recent days has been going up. Why is that? And what is that a premonition of maybe? Or what is that trying to tell us that maybe we need to keep an eye on? The metaphor that we've been using for those of you that are new is this metaphor about the economic coaster. And we've been on this train ride now for a couple of years, but for a large part of that time, we've been talking about the inflation story, which is still with us. We are now gradually moving along the track there, as you see, to this area, which is called stagflation, which is kind of a very challenging time. And I think a little bit of that's what we're experiencing now. As we move into maybe a slow growth period with still some endemic inflation that seems to be a little bit stickier than we hope. So we want to kind of understand a little bit more about why that is so. What is different about this period? I think that we're starting to grasp a little bit as to what this means going forward is basically looking, if you've fortunately been long enough and around long enough since 1980, you might understand this. If you're young, you might not have witnessed all this. But from the 1980s on, we went from a very high interest rate period to a period of progressively lower interest rates. Maybe it was 18, I don't know, it was 20% at one point. And then we went down to ground zero, really 0%, and even negative interest rates in 2020. And so we experienced a period of globalization, which gave us access to a lot more markets, cheaper goods, abundant labor, integrated supply chains, cheap money. Eventually followed that because of a deflationary tilt. So we went down this glide path of progressively lower interest rates, which is a good thing. We had a lot of prosperity. Conflicts in the world were mostly local to a large degree. They weren't really on a broader scale. And now we're moving into a period where there's a lot more instability. I think we're witnessing that personally in many respects. We feel it. The deglobalization effect, where nationalism is now taking a bigger impact on us, moving supply chains back to local, those type of things. And this idea that, what's going on? We have a low unemployment rate, yet we seem to have slower growth. There seems to be something different about that as well. Why don't we have enough workers, which we've always had an abundance of workers in a globalized world? There doesn't seem to be enough people for the jobs as some of the things that we think when we go to a restaurant, there isn't enough servers. We're also moving now into another period of expensive money, higher interest rates, near 5% on the Fed funds rate. And this idea of quantitative tightening, a kind of a difficult concept, but basically removing money from the economy, trying to reduce the inflationary pressures. And then moving more to this feeling like we're always at war, the world's at war, maybe not direct kinetic war, but it's some form of trade war or something else. So these things are problematic because they cost money, they create inflation basically, which is what we're witnessing. However, good news, we are seeing that come down from the peak last year in June. We were at 9.1 somewhere around June, and then we're down to 6.4. But there seems to be a little bit of a problem here that it's come down pretty quickly, but there seems to be some stickiness effects that we're seeing and we're witnessing as we go to the stores to buy food and groceries. We noticed that bread prices have gone up maybe more than we thought normal, 20%, I think, year over year. We're seeing it in a lot of the basic necessities of food. And why aren't they starting to come down quicker? Eggs are going up. I know we've had the avian flu. So what's going on here? Um, there's an interesting comparison here called the hog corn ratio, which I found kind of an interesting way to look at this. Generally speaking, when corn is cheap, basically, we would probably produce more hogs. And when corn is expensive, we would probably produce feed, any kind of feed, then we would produce less meat. And so we're seeing this kind of scenario develop here where we're seeing parts of the food market are dislocated in terms of production, where we're seeing a lot of the basic necessities that we use are still pricey, and that's creating the stickiness effect. As you look at what causes inflation, it's the big four: it's food, energy, housing, and labor. Okay, so shifting to labor, without enough workers, as I was saying, we seem to be at a very low period in the last 40 years of unemployment. And that's not just in the US, it's global. And the main reason for that is that there seems to be more jobs, a supply of jobs, 10 million jobs available, but only 6 million workers domestically in the United States. Uh, there's a lot of theories about that, but some of them are obviously COVID changed things. Many of the we're not having as many the young and the millennials coming up. They're basically not making enough money in some of the jobs that we'd expect, maybe in those service jobs. There's just a big disruption going on with a lot of baby boomers, demographics, and some other trends that are global that are creating a condition where we just do not have enough people to do the basic necessity jobs. So what has to happen? We have to raise the cost of labor, and that is one of the stickier ones that is more difficult for the Fed to solve with trying to eradicate inflation. So we have that stickiness effect. We have a global war going on, kind of almost everywhere these days. It seems like there's some kind of conflict. If you look over in Germany now with the disruption of energy supplies and other food supplies, we're witnessing higher inflation in Europe because of that. We had it in the US. We're seemingly now maybe have peaked out, but the war is essentially inflationary. How do they pay for wars? Most of the time it's with some form of printed money. That's usually how it's done. That's what happened in the Vietnam War and why we had the 70s, partially because of the aftermath of all that spending. And we're starting to see the signs of that affecting us as well. There are some green shoots, fortunately, which is good signs. Maybe things might improve here gradually, not as fast as we like. We had very strong retail sales in January, which is very positive, better than expected. The problem again with that on the converse, on the other side of the token, is that means demand is not weakening as much as the Fed would like. So it's a good story in terms of the economy, but it's not necessarily good for what the Fed might be doing with interest rates. We also had home builder sentiment pick up, which is a good sign. Home builders feel more willing probably to want to continue, building new housing and so forth. However, the home buyer is not exactly engaged in that. But the good sign is new residential construction is a big contributor to GDP growth. And we do have a housing shortage. I think last year was something about 5 million units. This year, I don't know exactly what it is, but I still think there's an undersupply. There is some good signs that rents are now starting to abate in terms of the rent increases, which is also part of that big four of the inflationary picture. So what has really changed here significantly in the last few weeks is that the Fed, because of some recent economic data, the PPI, which is a producer's price index, went up about 0.7% month over month, which is an 8.4% rise. That sent a shock through the financial markets in the last maybe week or so. as to what that means because of maybe stronger retail sales. Demand is still strong, and we had also a higher producer price index, which means there's endemic inflation in the supply chain. This has now raised the concerns that the Fed is not done and has a lot more to do before interest rates peak. Some numbers we're talking about 5.5% to 6%. We're not even at 5 yet. We're at 4.75. So this is starting to affect us now. We're starting to see the evidence yesterday and I think Friday in the financial markets with equities now really starting to roil and toil because of that. The terminal rate or the gradual glide path of interest rates has changed as well with recent payrolls. We had 500,000 payrolls increase in January. Another effect that we're not seeing, one of the signs that the Fed might want to see is a little bit more unemployment to reduce the demand. The Fed, again, uses a sledgehammer approach to this. They don't control many other things except for the cost of money. But the cost of money affects us everywhere, right? It affects us in, new home prices. It affects us in cars and credit cards and so forth. This is all leading to a problem with the yield curve, which is an indicator of what people feel about every kind of financial asset you can think of. Everything from credit to the way that you invest your money. And when the yield curve is inverted, it's saying that investors are not particularly optimistic about the future. They think interest rates probably will come down. Why would they come down is the question. Most of the time, it's because something's weakening in the economy. Generally, it's an indicator, it's a barometer of economic growth. If you had strong economic growth, you'd probably see the yield curve on the short end lower than the long end. And we've been witnessing this condition for some time. We don't know if we're going to be in a recession. It feels a little bit like we're going into something of a slower growth period, but still, we're expecting still to have positive growth this quarter, 2.2%. The leading economic indicators are summarizing all of this as we've been talking about over the previous months. Not a good sign in general. It means still we're in a period of challenging times ahead for us, at least for the next 6 months, maybe 9 months. And why is that so? Possibly, well, we've been fortunate because of stimulus and everything that happened during COVID with all the stimulus money, fiscal and both monetary, that the general person essentially was able to put some money away. They saved some of that money, and then gradually they spent that money down last year. But what's changing really rapidly here is we're starting to see the evidence of credit card growing up, which is telling us that's a warning sign that the consumer is tapping out. If we just take a quick look at the consumer debt by age, we notice that the younger generations, particularly the ones that we expect to buy the houses and all the other stuff, they're pretty strapped. Their debt's going up more significantly with student debt and some of these other areas than some of the older generations. The 70 plus seems to be in pretty good shape. Again, most of the people over 60 generally, most of that wealth in America is concentrated in the higher age groups. It makes sense. They've had more time to save. They bought a home. They accumulated some net worth along the way. So what is the ISM telling us, which is a barometer of economic growth going forward? The ISM dropped below 50, which 50 is generally the sign of zero growth or contraction, beginning of contraction. If you're below that, we're seeing non-farm payrolls went up, which is a good thing, but we're seeing a divergence here with the ISM. This is kind of another sign that there's something, this should be pretty correlated here when we're seeing a divergence. So some economists feel that this is possibly telling us we're going to see some lower employment numbers coming forward this year, as these two will come together with much of the ISM index is kind of at this juncture showing that may stay about where it is or might even go lower depending upon what happens. We talked about most of this. I think the other ones that maybe might be worth just talking about, a good news is that on the greens, natural gas has really dropped. And in fact, it's dropped even lower than this number. This is a little bit old here, but we're seeing the natural gas prices really come down. And as I spoke last month, natural gas is about 40% of the energy that we use for most of our electricity and things like that. So it's a big component of inflation. So energy costs, at least on that front, look good. Not so much at the gas pump lately, as they seem to be gradually rising back up. Retail sales a positive number, as we mentioned. The debt continues to grow 2 billion a day, and interest rates are not helping that. The dollar is weakening. Good news that basically eases some things about some of the export trading, but also is a sign of weaker financial conditions, which is what the Fed is a little concerned about. So the Fed might be starting to go ahead forward and try to tighten up a little bit further. Shifting ahead to what's going on in the financial markets, what does this mean? Well, good news as an investor, we started to see some good news in the markets. January was a great month. In fact, we hit the January trifecta, which is a harbinger that, generally speaking, if we probably don't go into a recession and we just have a little bit slower growth, the stock market might be reflecting that we're past the worst of it and that this year might be better. The negative side of that story, though, is earnings are dropping. We're starting to see some revisions there. And if that doesn't come back up, then it's hard to see how you could have a rising stock market with negative earnings growth. They usually don't track very well if they're one's going the other way, or they track very well. If one's going down, the other's going down. That's what I meant. If the other's going up, the other one's going up as well. Revenue growth has been abating a little bit, a sign of slower growth, but corporate profit margins have been hanging in there. If you look across the sectors, most of the sectors are all up, which is great for the investor on the equity side. What maybe drove that in January? There's a lot of people that felt that many of the large institutions, particularly the hedge funds, they were on the wrong side of the ledger. And when the market turned precipitously in early January, they were caught short of the market. And so that led to a springboard effect for the markets to jump back up. So where we are now, where are we going next? The markets are kind of at a weird spot right now. It's really trying to figure out what story is going to win. Is the economy going to go into a soft landing or no landing, or are we going to go further down? We've been following this 200-day moving average here, and 200-day moving average is basically been the headroom for the upward part of the market. We broke through that in January, which was a good sign. However, in recent days, this is dropping back to about 4,000. If it breaks through that in the next few days or weeks, that's another indicator maybe it was another one of these, and that we might have further downside as a result. The big issue here, again, is earnings. Is corporate America going to be able to keep its earnings? You notice a lot of the big, large firms, particularly in tech land, have all started laying off employees. Not necessarily bad, because I think those people will find jobs, because I said there's not enough workers and talent is at premium. But it is telling us that we're seeing some issues that they're worried about earnings. And this is the problem for the stock market, is the earnings picture. In recessions, they're talking about $200, maybe $220 of earnings this year in the S&P 500. In recessions, you can get down to this lower end curve. And that's the risk factor. So what probably looks like it has a good chance of doing well this year? Well, if interest rates do come down, hopefully, then we might be seeing lower interest rates, which means that helps the fixed income market. And that is not a bad place to maybe consider looking at, as because they've done pretty well when you see lower interest rates, because bonds do appreciate. Just an idea for tossing it out there, we did a little analysis here on why people should consider stopping losses on their investments, particularly in retirement, because there's not enough years to recoup. And we did a comparison of a stop loss strategy versus a buy and hold strategy. The stop loss earning a little bit less, maybe 5.5, maybe a loss of 10% in the third year, versus one that had a little better return on the long term, but a 25% loss in year 3, and then 6% for the next 4 to 30 years. What actually would have happened? And when you look at the numbers, the stop loss, which is portfolio 1, it actually would have grown to a bigger number. And the distributions in the 30th year would have grown to a bigger number as well. So something that just to keep an eye out for is just thinking about, we're in still risky period here. You can invest, be prudent, but also, consider managing your way through this because most of us really don't have enough time to recoup. That's just an idea for thought. Recession or not recession, who knows? We're still kind of debating that. There's a lot of reasons why. With unemployment at 3.5%, you probably don't get a recession. If credit gets really bad with people spending too much, well, because of high inflation, that's going to be a problem for the consumer. What do people do? They cut back on spending. What does that mean? Companies cut back on employees. And so then you get what is basically the unemployment effect. Okay, just a few ideas, just to wrap up real quick. We talked about AI. AI is still front and center of everything. We keep on learning more things going on there every day with what's happening with the major leaders of the tech land, Google, Microsoft, Amazon, and these new entrants and what might be some things that might be the broader to the economy. McKinsey just came out with a study, said about 25% of white collar jobs might be automated with AI by 2030. Think about that for a second. That's a big deal. So we all need to consider what are we going to do and keep ourselves viable and relevant in this rapidly changing world. A few other things we're seeing a notice of change here with some of the newer social media apps, TikTok, now coming up very rapidly versus the old guard, particularly with the younger generation. And that's usually who leads in this area, particularly as younger generation. What they're using is what's going to become the next leaders. Metaverse is still moving faster and faster. And there's, again, that's a demographic issue. Again, the younger generation really adopting the metaverse, reality faster than ever. So these changes are coming fast at us and furious. So those are my thoughts for today.